Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the first quarter of 2018. My name is Nick Basso, and I'm a portfolio administrator in Ironwood's Asset Management Division. As always, it's my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Steen Rogers. Steen is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Steen during the presentation, please feel free to type those into the chat box that is attached to your webinar panel on your screen. I'll compile the questions and we'll do our best to address all of those at the end of the presentation. And now, without further delay, please join me in welcoming Steen to lead this evening's presentation. Steen, the floor is yours.
Thanks, Nick. And good evening, everyone. Thanks for joining us here on the call tonight. I should just go back to November 2nd, the last time we did this webinar. The S&P 500 was at 2580. The S&P 500 today closed at 2581, believe it or not. So we really haven't gone anywhere. So it's been a boring quarter, right? I'm just going to replay last quarter's webinar and then we'll go from there. I'm totally joking. We've had a lot happen, especially this last week. But I did think that it was pretty ironic, I guess, that the last time we did this was November 2nd and the S&P 500 was 2580. What was a little bit different back then is the 10-year Treasury was at 2.35%. It is now at 2.85% roughly, so half a percentage point higher. And that'll be one of the things we discuss tonight. But I thought I'd start off with a little humor here and a little irony about the last time we had one of these webinars. And it's not been a flat ride this past quarter. It's been quite the up and then quite the down. So we'll go through that. We've got a lot to cover tonight, so I will get on with it. We'll make the attorneys happy here by leaving our disclosures page up for a couple of seconds. So believe it or not, the global expansion has actually picked up even more. We've been discussing it for the past couple of quarters now, so we'll go through that. Easy money is a thing of the past, question mark. We'll start talking about what central banks, not only the Fed, but central banks across the globe have planned for the next couple of years and kind of what our thoughts are on what has been going on the last 2 weeks or so, because we think it has a lot to do with the Fed and not just the Fed, but global monetary policy. We're going to talk about earnings because even though the S&P is at 2581, the same place it was at 3 months ago, we believe we're in a much, much better position than we were 3 months ago. And believe it or not, I had to redo this webinar a few times already, which is fine. You know, it makes life exciting here in the markets. But the original topic of the webinar was going to kind of have a theme of, hey, we're getting a little bit overvalued here. And now we've got a little bit different theme going because we've dropped 10% in the last 6 trading days. So anyway, we're going to talk about earnings and how we're in a much better spot now than we were back in November. We're going to talk about fundamentals, and we're going to talk about we're going to let history be a guide for us and have it teach us a few lessons. So first things first, global expansion and how strong this global economy actually is right now. We frequently look at this heat map when we do these calls. We have a global purchasing managers index manufacturing index of 54.4, 54.5 in December. You can see the dark green in Europe, in the Eurozone, and in Japan, and in the US, and in Canada. Everything's gotten much, much darker green. We see some 60s in here. By far, we've got the best economic growth that we've seen in a very, very long time. Of these countries, there's only one country that's below 50. And remember, below 50 is contracting, above 50 is growing. So every single one of these countries, except for Indonesia, and they're just barely contracting, but every other country is growing. And we see a lot of green in here. Developed markets, 56.3. Emerging markets, coming from yellow, going to green, and they're 52 and almost 52 again. So the global growth is not an issue at all. Europe's doing very well. Like I said, the US is doing well. We're seeing a synchronized global expansion here. If we focus on the US economy, at the beginning of the year, the 10-year Treasury was at 2.4%. Today, we ended just below 2.85%. ISM manufacturing numbers for January were very, very positive, 59.1. The ISM non-manufacturing numbers were 59.9 in January, the highest level we've seen since August 2005. And it's the 96th straight month of expansion in the U.S. non-manufacturing sector, so the service sector for the most part. The January jobs report showed 200,000 jobs added. The unemployment rate at 4.1%. The labor market tightening, 152 weeks in a row that weekly claims have been under 300,000. That's the longest streak since 1970. And finally, one of the last things that came from the jobs report, and this is where some of this started, was average hourly earnings increased by 2.9%. And that, after that jobs report, is really where we saw a big jump in the 10-year Treasury. And it's because folks are expecting, because that wage number finally started to tick up. We've seen a lot of 2.5s, 2.3s, but to see 2.9 year over year, that's really what caught the bond market off guard, and that's why we saw the bond market tick up so quickly, the rates. It's because economists are now expecting maybe 4 hikes from the Fed and maybe quicker tightening than before, because as wages increase, it could lead to some inflation, and some of the inflation numbers have been ticking up as well. So it's really markets afraid of interest rate increases because of inflation fears. That's really what we've seen since January 1st. GDP growth in the fourth quarter wasn't as strong as the third quarter. It came in at 2.6 versus 3.2 in the third quarter. Once again, that 2.6 number is a preliminary estimate, the first estimate. There's a reason that came. We think there's a good reason that came in a little lower than Q3. It has to do with inventories, and we'll talk about that here in a little bit. We believe that in 2018 we could see 3% growth for GDP. We think with the tax breaks, with where the economy is, with where we believe things are going, we're looking at a 3+% GDP growth for 2018. We've looked at this chart here in the past as well. So this is the third longest recovery now in length of time. You can see we had the big dip here, and we're getting to the third longest recovery Really, we're only a couple of months from this becoming the longest recovery. But as you can see, as far as GDP recovery, GDP growth, we have a long way to even get close to some of the previous recoveries and economic expansions. So although we're at 103 months duration, the actual cumulative GDP growth is still pretty anemic. And if we take this a step further and we look at, okay, let's look at the last 10 bull markets. In duration, we rank the 4th out of 10. In price gains, 264% basically. That's only ranking 6th out of 10. And then PE at peak, 21.4. This is using trailing PE, so I frequently talk of forward PEs. This is a little bit different number, but still gives you an idea how valuations looked in the past. We're only the 4th highest valuation that we've seen. If December 31st was the end of this bull market, we'd be 4th, 6th, and 4th. So a lot of folks are saying that this bull market is long in the tooth and prices have gone up too much. Well, if we really look at it in a historical perspective, we'll find that it's just about average right now. It's 4 out of 10, 4 out of 10, and 6 out of 10. So, not super out of the norm. PE multiples, and why I always talk about them. Sometimes I just assume people know what I'm talking about when I talk about PE multiples. So I added this slide in just because I think it's important, because I do talk about valuations a lot, and it's because I think they're really important. When somebody tells you what the price of the S&P is or the price of the Dow, well, in relation to what? There's probably a good chance at some point in the next 50 years, the Dow hits 100,000. When? I don't know. I would imagine it's when earnings go up high enough to make it make sense. So in relation to what is with earnings. So when I'm talking PE multiples, I'm talking the price of whatever we're talking about. So the price of, let's say, the S&P 500. Well, earlier today when I was fixing this slide, because I had 2,700 here yesterday, today in the middle of the day I fixed this and it was 2,650. The actual closing was 2,580. So we'll use 2,580. I have the math on that. I actually did it. So at 2,580, which is the price of the S&P, forward-looking earnings estimates, the E, earnings from the S&P for 2018, we expect $154 a share. If we do 2,780 divided by 50 or 154, we actually get a PE multiple as of today's close at 16.7 times. That number just a few days ago was closer to 18 and a half times. So we've lost almost 2 multiple points in the last, call it 2 weeks. Okay. We're right back where we were November 2nd when we did this webinar. And the reason I'm more positive today than maybe I was in November is because today earnings estimates are $154 a share. Back in November, they were much, much lower. One of the reasons is because we had a significant tax reform package passed, and everybody adjusted their earnings, their after-tax earnings. We also have had a growth pickup since then. So these are all things that will increase earnings estimates going forward. And when we have stock prices come down, but earnings estimates go up, well, you get a better PE multiple. So I feel a lot more comfortable when the PE multiple is 16.7, where it is now, versus 2 weeks ago when we hit 28, I want to say it was 28.70 on the 70 something on the S&P, and the PE multiple was 18.5. So that explains why PE multiples are so important. It gives us the in relation to what when prices, the S&P will follow earnings over the long run. So that's why earnings are so important to where the price is. And then what people will pay for those. How many times will they pay? Well, if interest rates are low, people tend to pay a little bit more for a cash flow of earnings. If interest rates are higher, they tend to pay less. So our current 10-year real yield is about 1%. We could make a case that the long-term PE multiple, that the average PE multiple that people are usually willing to pay is usually around 16 times. With a real yield at 1%, you can make a real strong case that maybe the fairly valued PE multiple is somewhere between 18 and 20 times. We're at 16.7. Interest rates have gone up, so we're a little bit higher than 1% real yield as of now, but we're not a whole heck of a lot higher than that. But as rates go up, that PE multiple that we expect is going to get closer to that average PE multiple that we've seen in history, which is somewhere between 15 and 16, call it 16. So that's why PE multiples are so important, and that's kind of how they relate with interest rates as well. So like I said, this chart right here was as of the end of January, so not that long ago, 8 days ago. PE multiples were 18.1. As of today's close, they're 16.7. So if we look at the latest PE multiples in relation to the 25-year average, and we look at, okay, are we overvalued? Are we undervalued? Where are we at now? At these levels, after today, we're much closer to the 25-year average with a lot lower yield environment. Now, a little higher than we were at the end of the year, a little higher than we were last November, but still, I would anticipate PE multiples and other valuation metrics. I would be okay if they were a little elevated given where we still are with interest rates. So just trying to kind of show you where we are in relation to where we were a couple of weeks ago. Now, Sean, you're talking about PE multiples. Why valuation metrics? Why are they so important? Well, in the short run, they're not really that important. And you can see that by this chart here. If we were to take the PE multiples and then the next 12 months return when PE multiples were at certain levels and we were to track them, you can see that this scatter plot, it doesn't really have any tight correlation. There's no orderly pattern here. It's all over the place. The R squared is 10%, so it's not a good fit. The regression line is not a good fit. So it just tells you that if I were to look at the current PE multiple now, this says 18.1, that was at the end of January. The current PE multiple is 16.7, so maybe we're a little bit up here. Over the next year, I have no idea what that doesn't tell us anything about what the next 12 months return is going to be on the S&P 500. However, if we take that 1 year and we say, okay, does a PE multiple tell us anything about the next 5 years return? That's this chart over here. Yes, we have a much higher R squared. This is a much better regression line with this data with 5-year annualized returns. So what this tells us is that PE multiples can give us some insight on longer term returns, 5 years, 10 years down the road. So if we're at an 18.1 multiple, we're going to expect, all else equal, a lower return going forward than if PE multiples are at 16 or 16.7. You know, 16.7 is, let's say here, we would expect a higher return over the next 5-10 years than we would when PE multiples are at 18.1. That's why they're so important. Doesn't tell us anything about short run, tells us a lot or a lot more about the longer term returns from the S&P 500, from emerging markets, from international. We can look at valuation metrics regardless of what market we're looking at. Okay, so now we take this a step further and we say, okay, why are people willing to pay more for earnings? Why are they willing to pay 16 or 17 or 18? Well, when people become more confident on what the economy is going to do, they tend to pay a little bit higher multiple, all else equal. And so this chart is just showing multiples and confidence and how they move very similarly. And so when confidence goes up, PE multiples tend to go up. And that's kind of what we've seen basically over the last 2 years. And really, basically since the financial crisis was over, late 2011, when the double dip recessions ended, you can see confidence just kind of slowly climbed. Yeah, it's choppy, and PE multiples are choppy, but we basically went from 12 to 10 PE multiples all the way up to 18, and now we're back at 16. So 16 is more normal range. Okay. So that kind of tells us where we are from a stock market perspective. What about the economy and in particular the U.S. economy? So we look at unemployment and we look at wages. Unemployment, like I said before, we've had a huge drawdown in unemployment all the way down to 4.1%. If we have 3% GDP growth, it's likely that unemployment ends up somewhere around 3.5% this year. If that's the case, the wage growth that we've seen, and we saw 2.9, this is a slightly different wage growth number here, but the wage growth that we saw in January of 2.9%, if we get a 3.5% unemployment rate, that wage growth is probably going to have some pressure, and we most likely will see above 3% wage growth as those come down. And if that happens, it could lead to some inflation. If the inflation is quick, or if expectations of inflation are quick, then people are going to expect the Fed to move faster, which is going to raise the 10-year Treasury. So, you know, this right here has a lot to do with what's happened, in our opinions, over the last 2 weeks. We believe that the most recent job report was very strong. The good thing is all of the data that's come in since the market's been pulling back has been very strong. It's the only thing that's been an issue is we had volatility spike up, and we had the interest rate spike up, which caused a lot of what is happening in the stock markets. How are we doing with the cyclical sectors? The light vehicle sales, they've come down a little bit. They had a spike, but they've come down a little bit, but they're still above their average here. Housing, still slow grind upward toward the average. Real capital goods orders, very positive trend. And then the one that I think is probably the most important, and one that in past webinars we've talked about as a hey, we need to keep an eye on this, was inventory levels. And you could see we had increasing inventories, and since then they've come down. And this last report that we got, inventories came down dramatically. And that's one of the reasons, if you've got a bunch of inventory, that inventory has already been counted in previous GDP reports. So if you have inventory that gets used, well, you didn't make as much. You used your inventory that had already been used in GDP figures. So this is one of the reasons that we think that GDP numbers coming in below 3% is because a lot of that was due to inventory numbers being used up, and that will be positive going forward because now we don't have this headwind of high inventories. The headwind pushed us backwards in the fourth quarter last year, and now it's kind of behind us. So anything going forward, any demand that we have, you're not going to be able to go to your inventories because they're getting to levels where they're getting a lot tighter. The consumer still looks fantastic. If anything, the tax reform is going to give them some money in their pockets in looking at the whole. It's going to make them even stronger than they were. We've got $7 in assets for every dollar in liability. Household debt service looks even more fantastic now with some of the tax reform stuff. Household net worth, although it's taken a hit the last 7-8 days, still at very high levels. So the consumer looks good in the U.S. Business sentiment looks good in the U.S. Growth looks good in the U.S. There's a lot of positive things that are happening in the U.S. There's also a lot of positive things that are happening internationally. Last year, 5.4%. Estimates for 2018 are 5.7% for global growth. That's a pretty big uptick there from where we were in 2016 and 2015. And then if we look at earnings per share, you can see this had a huge jump over the last couple of quarters. I looked at the last graph we had on here, and we were down like here. And the thing we were saying is, usually earnings per share follows GDP growth, and sure enough, earnings per share for global, the MSCI All Country World has definitely had an uptick in earnings, and it's following that GDP. And all of the economic reports that we're seeing is everyone's revising their GDP estimates higher. So that means they should be revising their earnings per share numbers higher. So these price decreases that we've seen over the last 8 to 10 days, it's only making things look more attractive because we've got all these other things that are improving. Europe looks very strong. Unemployment's coming down. I thought this was a good one to add in here again and get it updated. In 2017, we had a 5% outperformance in international versus the U.S. And you can see here, typically these things last. We've got 2.5 years. The international outperformed 80% cumulative. Then you have the U.S. outperformed for 30%. And international by 89, U.S. by 51, and they're different time frames, but they usually last a little bit of time. International beat domestic by 375% in 6 years, and then domestic outperformed international by 100%. You get the picture here, and we've started, and this is something that we've been talking about for a while now. U.S. has had an 86% outperformance on international. Well, last year was the first year that we've seen, in many years that we've seen international markets start to outperform the U.S. market. We believe that has a lot to do with valuations. Okay, here comes Sean talking about valuations again. Once again, these are as of January 31st, so they're going to look a little bit different, but you get the idea here. The S&P 500 a couple of days ago, 18.1, 20-year average 16. Dividend yield 1.9, 20-year average 20%. So PEs now are, 16.7, 20-year average still 16. Dividend yield, maybe it rose to 2.1 maybe. So now we're looking at the S&P and we're looking, well, the S&P looks a lot better than it did 10 days ago. Well, yeah, of course it does. Not much has changed as far as economics and as far as earnings, but prices have come way down. So of course it looks more attractive. And then if we look at the All Country World Index ex-US, before all of this happened, 14.5, 20-year average 14.5, dividend 3, 20-year average 3. Okay, so why does it look more attractive? Well, internationally we have low interest rates as well. So I'd make the argument, just like I'd make the argument that the S&P earnings that valuations could be elevated because of low interest rates. I'd make the same argument that outside the U.S. we could be overvalued. And if that's the case, then that means that All Country World Index ex-U.S. is probably undervalued relative to the U.S. It really is undervalued. And then you throw in the fact that we're probably at 14, not 14 and a half now after the past couple of days. And dividend yields are probably back up to 3.2, 3.3, something like that. Maybe we're at 13.5 or a little higher than that. You can see why we're very optimistic about companies outside of the United States. And then we said, okay, if we started with two portfolios that started in 1997, where would we be right now? And you can see that from the financial crisis, the outside the United States is up 140%. It hasn't even gotten back to the price that it was before the financial crisis. And then you look at the S&P 500, and it's up 317% since the very bottom, March of 2009, and it's much, much higher than it was before the financial crisis. So that, just different pictures to show you kind of why valuation metrics look more attractive outside the United States. Central banks and interest rates. And I think this is the wild card. And I think this is why there's a lot of worry out there. And to be honest, what the central banks are about to do is unprecedented, just like when they inflated their balance sheets. So this is something that we definitely want to keep a good eye on, and that we want to make sure that we have in our models, and that we're making sure that we know what's going on here. The central banks have been very good about giving us a game plan, and thus far it hasn't really worried the market too much. But a good jobs report here, wage growth, and then a little inflation, and people start to get a little worried. So a new Fed chair, and you get the idea here. But we've had almost 40-year bull market in bonds. As interest rates go down, bonds do well. Well, the last, call it 7-8 years, bond rates have been in this range here. So you can kind of see, they went down and back up and down and back up. But if this is a consolidation here and we can go back up from here, which we think is possible from these levels, and you can see even January 31st, we're at another 10 basis points higher since then. And if you looked at January 1st, it was 2.4%. So we've moved a lot here in a very short period of time when it comes to interest rates. So you can see real rates have just blasted off here in the last, call it 6 months or so. One of the reasons is this. Now, we did QE1, we did QE2, we did QE3. We added $4.5 trillion. Well, we added $4 trillion to the balance sheet, basically. And now we're going to start to get rid of it. The Fed in 2017 started, at the very end of 2017, started to reducing their balance sheet by $10 billion per month in October, November, December. So 2017, they got rid of $30 billion, which when you're looking at $4.5 trillion is not very much. But the plan is to increase that monthly number by 10 billion every quarter. So that means 20 billion in the first quarter of 2018 per month, 30 billion per month in the second quarter of 2018, 40 billion per month in the third quarter of 2018, 50 billion a month in the fourth quarter and beyond. So what does that mean? That means in 2017 we had 30 billion at the end of the year. In 2018 we plan on having 420 billion reduction of the Fed balance sheet in 2018. So we're starting this process right here. In 2019, so 30, 420, and then in 2019, $600 billion. So they're outlining it for us. They're showing us this. We never did this before, this QE1, QE2, QE3. So if we've never done QE1, QE2, QE3, we sure haven't done the opposite of that either. And so that is going to be where I think there's going to be a lot of uncertainty, and markets aren't going to like things that come out of what the Fed says, and we're going to need to monitor that. But remember, in the long run, equity prices follow earnings. So earnings are what is important. Don't let shocks like we've seen over the last 10 days get us super worried. I mean, if we needed our stock portfolios in 10 days, then we probably shouldn't have been in stocks. And we'll go over time frames later, but the Fed is not the only central bank that is starting this process. And so if we look at all of the central banks, or at least the four big ones, the Fed, Bank of Japan, the European Central Bank, and the Bank of England, you can see we're getting rid of a lot of QE over the next couple of years. So we're still, with this, when this orange line is above zero, it means we're still on the margin. The Fed might be reducing its balance sheet, but the Bank of Japan and the ECB, they're both still adding to their balance sheets. They're a couple of years behind the U.S., and that's another reason why we feel a little bit more comfortable with some of our overseas stuff, because not until 2019 do we start to actually have a net reduction in balance sheets throughout the globe. Okay, why is this so important? Well, here's why it's so important. 2008, 2009, we had the financial crisis. If we look at the top 10 developed market central banks, you can see a whole bunch of them cut, a lot more than hiked. In 2009, there were 5 hikes. There were 30 cuts. In 2010, people thought, okay, we're through this. Europe, in particular, started to do some hikes. The U.S. did not. So there were some hikes, not a lot of cuts, and then about the same in 2011, about the same amount of hikes and cuts. Well, in 2010 and 11, Europe went into a double-dip recession, along with some other areas of the world. 2012, not a single hike. And you can see that we basically had easy money, a lot more gray lines than blue lines since 2012. We've barely had anybody raising. 2017, we barely got to as many hikes as 2009. And now, this line's going to start to get higher and higher, and that's what people are uncertain about, is what happens. Is the economy strong enough now where if we start to hike, we don't create a recession? And so that's the million-dollar question. And so Janet Yellen had been very cautious. It sounds like the new Fed governor is going to follow that prescription, but we'll see when he just was announced a few days ago, and the market welcomed him with open arms. So we shall see, but that's definitely something that we want to keep in mind. This global monetary policy is really important. It's going to be important for interest rates, which are going to be important for multiples, which are going to be important for stocks. Now, a positive note here is here was the yield curve at the end of December 2013 after the taper tantrum. And here was the curve as of a couple of days ago, January 31st. What's really important here is when the 2-year is above the 10-year, that's what we refer to as an inverted curve. That's very important. The reason it's so important is when the curve inverts, it inverted in the late 80s, and we had a recession. It inverted in the early 2000s, and we had a recession. It inverted in 07, 06, and a couple of years later, we had a recession. The good thing about so you can see we're heading down to a more flat yield curve right here, not inverted yet. What's happened over the last week is actually the curve has steepened, so it's gone the other way. So I see that as a positive. I would see although an inverted yield curve hasn't always predicted a recession, it definitely is one of those indicators that a lot of economists follow, and folks start getting worried when the yield curve gets inverted. So the fact that we've seen it actually steepen over the past 8, 9, 10 days is actually, in my opinion, a very positive thing, since we do believe that this is kind of an interest rate thing. When we kind of step back and look at it and say, okay, with stocks, we're at the same levels we were in November, which is pretty good levels. But yet earnings are better. We have the 10-year that's 50 basis points higher now. I mean, the way I look at it is we got a 50 basis point increase in 10-year treasuries, and stocks, although they went really high and then came right back down, we're in a pretty good spot in my opinion. And that's why sometimes when markets get a little ahead of themselves, for us to pull back and consolidate at a more reasonable level, that actually will lend itself to this bull market lasting longer. It could be over. I don't know. It's tough to tell, but the way I see it is we never got to levels that were blown out, and a correction like this is usually a healthy sign, and usually a 10% correction, which we finally hit on the S&P today, is usually a good buying opportunity, especially when you're looking longer term out. But even when you're looking shorter term out, usually when there's a 10% correction, that's a decent time to be putting money to work. The other thing that we have going on is a battle between what the Fed is predicting and what the market is showing. Now, this is also improved over the last 8 days. The Fed is outlining, these are the Fed plots. So the FOMC year-end estimates. They think the end of 2018, they think the Fed funds rate is going to be at 2.13%. Okay, the market is at 1.83. The end of 2019, 2.69 is where the Fed thinks will be. The market is at 2. and the market's at 2 going forward, where the Fed is at 3.06. So it's whether you believe what the market's saying or the Fed. And up until the last 8 or 9 days, the market has been winning. But the last 9 days, 8 days, the Fed rates and the projections have actually, the market's been coming up to them a lot more so than what shows in this chart. Now we're kind of like up here. So that's part of what's going on here. Interest rates and bond movements. I've talked about this a lot in the past, so I'm not going to hit on it too much, but just remember the shorter duration bond we have a 2-year treasury, and we have a 1% increase in interest rates. A 2-year treasury is going to lose approximately 2% price return. A 30-year treasury is going to lose 17.6. So we saw a 50 basis point increase in the last month. So that means this if you were holding 30-year treasuries in 1 month, you would have lost 8-9% in a 30-year treasury, give or take, in a month period of time. That's a pretty big move. And the extra yield you're getting for sitting in a 30-year treasury is nowhere near making up for the fact that you've got that much interest rate risk, in my opinion. And so most of our bonds are very short term, or we've got some floating rate, we've got some high yield in our portfolio that actually go up when interest rates go up. So knowing what kind of bonds you own is very important if you think bond rates are going to continue to go up. Global bonds, I just put this in here to kind of give an idea of where the yields are. So as of the end of January, the U.S. aggregate was up, almost 3%. Global ex-U.S. rates, you can get a whole 1.13%. Not very appealing. Japan, 0.22%. The German Bund, 0.63%. UK, 1.7%. Italy, 1. So bond rates not only in the U.S. The U.S. is actually higher than a lot of these other countries, but bond rates throughout the globe are still very low. Over the last 8 days, we've seen a lot of those bond rates come up. So it's not just the U.S. thing. It was a global thing. So how to navigate? Well, it's not sexy. It's not flashy. It's sticking with the fundamentals. So one of the things that we want to make sure is cash isn't paying us all that much. I know there are a lot of people who during Brexit or during some of the taper tantrum, they went all the cash, and they missed out on some really good returns up until this point. Cash is not paying us very much. If we look at how much money is in cash, there's $15.7 trillion in cash right now. Just to give you an idea, that's more than consumer spending in a year, and that's more than mortgage debt, all of mortgage debt. It's 50% more than mortgage debt. So we've got a lot of cash on the sideline, and it's not paying us high yields. Now, one positive thing about the Fed increasing interest rates is we do have interest rates going up, and we have people who are in retirement who have a big part of their portfolio is in fixed income. New fixed income that we purchase now, we're starting to get better yields on those fixed income instruments. Money market mutual funds. We just had a couple of money market mutual funds who are now paying 1.35%, 1.5%, 1.45%. So because the Fed is increasing that interest rate, that Fed funds rate, you're starting to get savers that are getting higher rates, which is going to help those folks who are in retirement or getting close to retirement, because they're going to have a bigger income from their portfolio if there's a big chunk in bonds. Now, another thing I wanted to point out on this slide is, so there's a lot of cash on the sidelines, and retail investors tend to buy high and sell low. And the perfect example of this, and it's easy to do. Your money and your emotions, they can get in the way, and you can end up making very poor decisions. And in history, humans have made poor decisions when it comes to timing the stock market. In January, we were up 8%, roughly 8% on most of the equity markets, depending on which one you're looking at, maybe a little more, maybe a little less. In January, we had $68 billion flow into equity ETFs in January. Market's doing well. People are feeling good. I think it's time to fund that account that I was going to fund, or I think it's time to put that money, I feel better about it. We can put money to work here. Well, if they would have looked at the PE multiples at 18.5, maybe they would have thought a little bit before they went and put money in at those levels. It's not that we want to not put money to work. We just want to make sure that we're not trying to time it when we feel good about things. But there was $68 billion into equities, and thus far, outflows in February. We're 8 days into this, and this is as of yesterday. So this is as of 7 days into February. We had almost $20 billion outflows. So people are not good at timing the market when emotions get involved. So we just want to make sure that we're not trying to jump in and jump out of the market. And cash is not a good long-term investment. It's paying very little right now. So the thing is to start with a diversified portfolio. Start with the end in mind. When do you need cash flows? How does it all come together? And make sure you're building a portfolio that fits your specific needs. I kept this one in here. I almost took this slide out, but now that we've come back, valuations still look. This slide, it's from June, but it actually still looks about the same. The BAA yield is 4.4, and as of yesterday, the inverse yield was 5.7. It's probably closer to 6 now. If we were to do that, I didn't do that, but 6 and 4.4. So we've got a bigger gap there than we had before. That's just telling us that stocks are relatively more attractive than bonds. And if you haven't gotten that from the presentation thus far, then I don't know where you've been the last 53 minutes. So we'll kind of skip that one there. Corporate profits. So this is just trying to give a little bit more insight onto the tax reform and how it's impacting future estimates. So a couple of things here. On January 1st, we already had the tax package passed, and on January 1st, forward earnings were estimated at about $148 a share on the S&P. And as of a couple of days ago, that number has climbed to $154 a share. Just to give you an idea, in 2017, that number was $125. So we're talking about an increase in earnings year over year of, if it turns out to be true, of about 23%. Okay? That's what's been driving the market. That was what drove the market in January. It was these earning estimates, both growth and because of tax reform, that were driving the stock market. Earnings have not miraculously come down. They're still very close to $154 for the next 12 months, but prices have, and so that just makes things more attractive. Once again, a case for international. Global earnings have come up for Europe, have come up for emerging markets, Japan, U.S. But if you look at Europe, we're not even to the point where we were pre-crisis. If you look at emerging markets, they just barely passed that point pre-crisis. I'm sorry, Japan. Emerging markets, once again, is not up past pre-crisis. So we think there's a lot of room in Europe, Japan, and emerging markets. And then if we look at valuations, developed market, 17.2. Once again, these are a little outdated numbers, 8 days. But they're just know that all these blue dots are going to just go down. They're just going to be more attractive. Emerging markets, just slightly overvalued in history, in relation to history. Developed markets, just slightly overvalued. S&P, more overvalued. Once again, do we have low interest rates? Yes, you could make an argument that they should be overvalued. And so that's kind of how we're looking at it. But now we're a lot closer to these purple lines, and we're probably under the purple lines for EM and for DM. So just making the case for international again. I'm going to skip this one today. Commodities. Commodities are a good piece to have in the portfolio, especially if we have inflation scares. Commodities follow inflation pretty close. So if we have hyperinflation, you're going to want something that's going to hedge that hyperinflation type of environment. A 5% sleeve of commodities in the portfolio, that's a good thing to have, because it's just an asset class that doesn't tend to act like stocks, and it doesn't tend to act like fixed income. So it's just an alternative asset to have in the portfolio. And then if we look at, okay, where are we at in relation to where we've been in the past as far as prices, the Bloomberg Commodity Index, you're on the low end of where prices have been in recent history. And you can look at agriculture, livestock, silver, crude oil, natural gas. They're pretty much all a little undervalued. The only thing that's really maybe a little overvalued compared to recent history is gold. Why we want to have bonds in the portfolio. So, as you guys can probably tell, I'm not really fond of bonds, but even with that said, the last 8 days, your bonds might be down, let's say 2%, where your stocks are down 10. So even a bond's worst day or worst year is a stock's worst day. And so the volatility that comes with bonds is a lot less. And because of that, you can prevent some downturns. And when you're, depending on what point in your career and retirement that you're at, we've got to have a certain amount of assets that we know are not going to fluctuate and that are going to bring in an income and that are going to help offset if we have downturns in the stock market. So I thought this was a fitting slide. If we would have had a 50 or a 60-40 portfolio versus the S&P 500, and we were to start in 1998, 100 grand. If we fast forward to the end of 2017, we'd have about $12,000 more in our S&P 500 than we would in our 60-40 portfolio. That's assuming that you didn't take out any money during this period of time. Now look at the ride you would have taken. With the 60-40 portfolio, we had our first drop in the early 2000s, and you're probably feeling a lot better only being down $9,000 from your original investment, September 30th, 2002. Then versus being down $31,000 September 30th, 2002. Then we look at the high, October 31st, 2007. You're at $154,000 with the 60-40 portfolio. S&P hasn't even gotten back up to that. And then you go and you lost a whole bunch more money, and you're right back down to where you were 6 years before, or 6.5 years before. You're back at $71,000, and you're 60-40. You've made money. since you started. So you're taking a lot less of a violent ride there. But you hung in there. You're young. Hopefully you're adding to these things, because it would make these dips even better if you were adding money. But this scenario, we're not adding any money. That 71,000 over the last 10 years, 9 years, has just taken off and caught right back up. And so over the long run, you made more being more aggressive. And the longer we take this out, the more the S&P 500 would win. But I just picked this to show the importance of having some safe assets in the portfolio, so that you don't get whipsawed to the point where you start making bad emotional decisions. I'm going to skip this today. This one's a new one that I added. I really like this one. We want to make sure that we have the right time frame when we're holding stocks. So if I take a look at 1 month holding periods, so you come to me and you say, I heard this stock market thing is doing pretty well. It made 21% in 2017. I want to jump in to the market. And I'm like, well, if you've got a 1 month time horizon, I'm going to tell you, no, stocks are not where you want to be, because there's only a 60% chance that we'll actually make money. Even if you told me you had 1 year, that's still not very good. 75%, we're in this to make money, not 75% of the time to make money. If we want to make money and we want to be in stocks, we need a longer time horizon. Okay, let's go to 5 years. 5 years, 90% of the time we made money. 76 out of 84 5-year periods. That's still not very good. To me, I mean, if I'm going to be in something that's going to give me a high return, but I'm going to take a lot of risk, I want to make sure I make money with it. So then we go 10 years down, 10-year periods. Well, stocks were positive 97%. Okay, 97% of the time, that's pretty good. So we don't tell people to even look at stocks unless they have a 10-year time horizon. And all you retirees on the phone, when you retire, you could still have 40, 30 years to go. So you still should have a good portion in stocks. And then finally, there's not been a 15-year holding period where stocks have lost money. 100% of the time we have positive returns when we have a 15-year holding period for the S&P 500. So just trying to tell us, okay, if we're looking at stocks, we want to have at least a 10-year period to have with, if we're going to invest in stocks, if not a 15-year period. Okay, so what if we have less than a 10-year period? Well, if we have less than a 10-year period, then we need to own some bonds. So now we add in 50-50. So we have 50 stocks, 50 bonds, and we go to that 5-year rolling. Now it's a slightly different. The other period was a little longer, but since 1950, there has not been. This is the 50-50 portfolio. There's not been a 5-year period where a 50-50 portfolio has lost money. Okay. So it's all about having the right time frame for your objectives. And the Ironwood financial planners work very hard to figure out what your objectives and what your needs are from the portfolio, so they can select the best portfolio for your situation. I threw this one in here again because I thought it was telling here of the last. I mean, this is as of January 31st, guys. We had a 6% year-to-date return at that point, and we had just started to have. We were at 8, and we dropped 2%, and part of the 2% was January 31st. And since then, we are now in the first correction that we've seen, 10%. We hit it today. First correction we've seen in a little over 2 years. It was early in 2016 that we saw a 10% correction. It was January to February 2016 that we saw our last 10% correction. So it's been 2 years since we've had a correction, but realize these are normal. If we look at all of these years and we say, okay, well, now it's a 10. We had a 3 last year, an 11 in 2016, and 12. This is the from the peak to the biggest correction within the year. If you look at the average intra-year drop, it's 14%. So 10% corrections are the norm. The last 2 years are what is not normal. Going stair step up in the upward right direction, that's what's not normal. What is normal is volatility in the stock market, and that's why we need to have the correct time horizons for owning our different stocks. And then finally, we added the volatility index in here. We had a couple issues over the last couple of days. A lot of people making bets on the volatility over the last couple of years. The inverse, they were making bets that volatility would keep coming down. And a couple of products that are supposed to give you the return of the inverse VIX index were actually discontinued and stopped. And that just when products like that go bust, it just adds more fear to the market and then more volatility, and it's a cycle. So fundamentally, long story short, guys, fundamentally, we don't believe that the market's changed a lot. If anything, it's just become a lot more attractive from a price perspective, but we don't believe fundamentally that much has changed. Now, that doesn't mean that if we keep going down and retail investors start selling and this market goes down, a couple more percent, and people start freaking out, and then CEOs are telling their companies, all right, let's get ready for this. And then earnings come way down. That it could be a self-fulfilling prophecy. Now, we don't think that that's going to happen, but it definitely is a possibility. So, we want to make sure that we stay disciplined, stay diversified, and over the long run, if we're buying stocks now versus 10 days ago, we're a lot more comfortable buying stocks at a 16.7 multiple than we are at an 18.5 multiple. So once again, asset allocation portfolio here, just a mixture of all of these asset classes. You can see if you're a golfer, right down the fairway. That's where we want to be. We want the portfolio to move very smoothly. If we had 100% in emerging markets, we'd have the best return, second best, second best, worst, -53. Best, 79. Oh wow, that's a good. But when you're building a portfolio that needs to be stable, you can't have those types of moves. And so that's why we build a whole bunch of these things together in a certain way, so that we can offset some of those, so that we're never at the top and we're never at the bottom. We're always trying to be kind of right down the middle here, and that's what that asset allocation portfolio helps us do. It's got a 15-year average return of 8.3%, and it's got a volatility or standard deviation of 11%. So on a risk-adjusted basis, that's a pretty good place to be when you're talking about risk versus return. Investment implications. We like commodities. We like international, obviously. We like market neutral. It can act kind of like a bond placement for us. It doesn't have interest rate risk, but it's got a very similar volatility to bonds, a very lower volatility. Emerging market equities, obviously we like international and emerging markets. Small cap has actually been out of favor for a considerable amount of time now. So we believe with the tax changes, there's some positive with small and mid cap companies. So we'd be favoring small and mid cap over large. Underweight fixed income, especially long duration, obviously. domestic equities, we prefer international. REITs and utilities, we didn't really talk a lot about REITs and utilities, but as interest rates go up, both REITs and utilities do not perform very well in an increasing interest rate environment. So we prefer not to have those. With that, I'm going to have Nick go ahead and take questions, and then I'll leave this important disclosure information up as well while we answer questions.
Hey, thanks, Dean. Let me jump right in here, and I've got the first question. Would you be able to explain the difference or differences between exchange-traded funds and exchange-traded notes, please?
Absolutely. That's a great question. So that question probably came for those that do not know. One of the inverse volatility products that was out there was a product that was a double inverse volatility. So it made money when volatility came down, and it was an exchange traded note that was offered by Credit Suisse. The difference between an exchange traded note and an exchange traded fund is that an exchange traded note is a debt obligation of, in that case, Credit Suisse, where they're going to pay an interest rate that mimics the double inverse VIX. Okay. But there's no assets that are behind it. It's the good faith of Credit Suisse that pays that return. Now, what Credit Suisse does is they go out and they trade a whole bunch of things that offset that risk, and they try and do it like that. Versus an exchange traded fund is actually a basket of securities. So if you've got the S&P 500 ETF, you actually, behind that is actually shares of those companies that's held by the sponsor company. So it is an equity. It's not a debt obligation of that firm. So that's the difference between an exchange traded note and an exchange traded fund.
Okay, thank you. Another question. This one goes back to the very beginning of the slideshow. You had mentioned an S&P 500 aggregate earnings estimate of $154 per share, I believe, and just wondering where that number comes from.
That number you can find that number in several different places. That number comes from analysts' expectations that have publicly given their expectations. One of the places that we go is Yardini. I can email the website. I don't know the exact spelling of it, but if you want that website, please shoot me or Nick an email, and I'll get you where you can find that.
Okay. Yeah,
that's a good question.
We know who wants it, so we'll take care of that.
Okay, perfect.
Okay, well, I've got no other questions at this time, so Sean, if you want to make some conclusions. Oh, actually, sorry, let me backtrack a second here. We have another question coming in here. During your discussion about global economic expansion, you mentioned the term contraction. How is your wife Ashley doing, and when is the baby expected?
Oh boy. She's doing well. Thank you for asking, whoever asked that. The contraction I was talking about was Indonesia.
Okay, well, I think that's it for the questions. If anyone has, additional thoughts, obviously, the lines of communication are always open here and seen. Why don't you go ahead and wrap up?
Thanks, Nick. So I think everybody should just take away that I think there was a little bit of greed in January. We heard it with some of our clients. I think this is a healthy correction. I don't think that the fundamentals have deteriorated at all. I think, if anything, this is a good buying opportunity. It shook some things out, and if you're a retiree on the call, a 50 basis point increase in the 10-year Treasury moving forward, that's really going to help our bond yields. It's going to give us an opportunity to change the portfolio dynamics of the bond portfolio to get some more yield. So I think all equal, I think it's actually a positive thing. The only thing that I am concerned, like I said, is that the central banks. And so we're going to keep a good close eye on that. But at the end of the day, we're where we are, where we were in November. Going back to November, if you asked us how we were feeling in November, we would have all probably said, we're doing pretty good. The accounts are doing well. We had a great stock market up till November. The only thing that's changed is earnings expectations have gone way up since then. And your 10-year Treasury is now 50 basis points higher. I'd argue that that's a much better backdrop to be at than we were back in November. Now we have the opportunity. Maybe there's going to be some volatility in the markets short run. Don't get me wrong. If we're putting new money to work, maybe we dollar cost average it in over a couple of weeks. You can ask your financial planner for ideas on that. But at the end of the day, I don't see much of a change in the fundamentals. And so at 16.7 PE multiples, half a basis point higher on the 10-year Treasury, I'm fairly optimistic on where equity prices go from here, domestically and especially internationally. So we'll leave it at that. Everybody have a great rest of the week, and we'll do another webinar in early May. Thank you very much. Have a great night.